Welcome to CoinPunks, where we discuss all things related to crypto. Let's jump into today's topic now. To hodl or not to hodl? To hodl or not to hodl? That is the question. Okay, let's back up and unearth what this means and how the term actually originated. Referring to Investopedia, the term hodl originated in 2013 with a post to the Bitcoin Talk forum. The price of Bitcoin had surged to a high of over $1,100 at the beginning of December 2013, from under $15 in January 2013. On December 18th, possibly in response to reports of a Chinese crackdown, the price of Bitcoin fell 39% to $438 from $716, according to CoinDesk's Bitcoin Price Index. At 10:03 a.m. UTC on December 18th, GameCube posted, "I am hodling," a drunk, semi-coherent, typo-laden rant about his poor trading skills and determination to simply hold his Bitcoin from that point on. Hodl soon became a byword for an approach to cryptocurrency investing that shuns crypto trading based on short-term price moves. Novice traders are likely to botch their attempts to time the market and lose money or make less than they would simply holding onto their coin. But there's still a mainstream stereotype that crypto heads are a speculative lot, that the space is wildly volatile and inherently risky. The ultra-early adopters of mainstream coins such as Ethereum and Bitcoin were heavily invested in these projects and didn't flip their assets to make a quick buck. It could be argued that hardcore Bitcoiners believe that the Alpha blockchain is an alternative to the fiat system and that it is actually a harder money than current currencies, which were originally backed by the gold standard. If you spent any time on Twitter following tweets by Bitcoin maximalists, you'll encounter laser eyes on many profiles signing off with hodl, diamond hands, or buy the dip. So, what's the obsession with this long-term play? Why not skim some coins when it reaches an all-time high, like May this year, when Bitcoin hit a high of $63,000? There are several reasons, but what sets a maxi apart from mere mortal crypto investors is arguably something referred to simply as time preference. And we need to ask ourselves if we have a high time preference or a low time preference. What's a high time preference? High time preference is defined as focusing on immediate well-being as compared to the average person. But focusing on deriving benefits in the immediate future has a cost. A person with high time preference discounts future returns to enjoy benefits in the immediate future. So, you want that game console or hot sports car? You can go out and buy it now. You want to eat that burger and fries? Eat it now and burn off those calories later. Logically, a low time preference is the opposite. An individual who is willing to forego immediate benefits for the potential of increased returns in the future. And having this low time preference means that you're not going to be concerned with the current market volatility of the asset you hold. You maintain a conviction that your asset is going to continue to appreciate over time. Okay, perhaps you may push back that you'll be ahead by selling off a percentage of your crypto of choice, making a profit, and then buying it again if and when it dips in the future. But there's no guarantee that this dip will ever arrive, in which case you are now further from your long-term goal. And I don't know about you, but I personally don't have the time to have my eyes glued to a screen day and night, constantly observing market trends. Life's already busy enough, and setting limit orders or automatic dollar cost averaging makes things much less complicated. Many analysts on the interwebs would suggest when the market is frothy and your crypto of choice begins to be overbought, that it's best to DCA, or simply dollar cost average, rather than attempt to time the market and wait for a nice little dip to grab more of your coins. And as the expression goes, it's time in the market that is optimal rather than trying to time the market. In this manner, you essentially add to your portfolio as often as you prefer, whether it's monthly, weekly, or even daily. This is the best way to avoid FOMOing when your preferred crypto starts to skyrocket and everyone wants in, and its price begins to peak. FOMO, fear of missing out. We've all encountered it. Don't worry, you're not alone. By the same token, many folks think they missed the boat as coin A or B is mooning and is currently far too expensive. But here's the thing. When your conviction level for an asset is high enough, you come to understand that it's a long-term play and that you're in it for the long haul. In the case of Bitcoin, proponents will argue that it's digital energy that will stand the test of time, that it's property in cyberspace, it's wealth that can be transferred to loved ones in the future, and is the hardest asset on the planet. The term hodler could essentially be swapped out for the conservative term investor from the equities and real estate markets. Sure, you can trade crypto instead, but in this case, you open yourself up to current market volatility, in which case you stand to either make or lose a great deal of money. And when the market's crazy volatile, the low risk play is to take a breather, and if you're in doubt, just zoom out. I suppose it just comes down to your risk tolerance. If you're a hodler, you don't need to be an expert with technical or fundamental analysis and be astute at reading charts. And in terms of finances, you're not losing any money on capital gains taxes since you're not selling off any assets. You may argue that if you're going to simply hodl, that you should just opt for the stock market and hold ETFs for mainstream coins, as it's even easier than buying your crypto of choice off of a centralized crypto exchange. For me, as a Canadian, we currently have 3 or 4 ETFs to choose from. And there's also the option to hold proxies such as Grayscale Bitcoin Trust, MicroStrategy, or Bitcoin miners that hold a significant amount of BTC on their balance sheet. But the counter argument here is that you don't actually own the asset. In the end, we all have different priorities and different financial goals and tools to meet those goals. Your tools might be equities, they might be real estate, or they may include digital assets. Your goals are not mine, and mine are not yours. And while there are several advantages to hodling, life happens. Bills need to be paid, and emergencies will emerge when we least expect it. If you're confident in your skills as a trader, that's cool, and all the best with your endeavors. And if you're a hodler, keep your head to the ground and hodl on. What are your thoughts on hodling? Leave your comments below. This wraps up things for today's video. Hey, if you like today's show, give it a like and subscribe by tapping that sub button. If you're on the go, you can get the same content in our podcast at www.coinpunks.ca. Hey, thanks for tuning in, and catch you in the next one.